appreciate you joining us on ET Now. That's exactly the question. 20,000 came and it came very swiftly, but since then it seems that we have hit a bit of a pause, especially on the broader end of the market, which was on a runaway rally. Do you expect that now the market momentum will shift towards large caps versus the broader markets?
Yeah, that's a fair assumption to have, primarily because when you look at the small and mid cap indices over the last YTD, the current year, they have outperformed the large caps by a very large margin. And if you look at even the last 3-year performance, that relative performance has been quite stellar for mid and small cap. And that's primarily because of there has been very strong flows into the category, and there has been some a bit of the flows into the large cap category has not been that strong. So going forward, having seen a very short rally, the earnings has not caught up to the extent of those the incremental market caps or valuations which has happened. So it is reasonably possible that that we could see some bit of moderate markets, at least in the broader markets, but large cap space, it continues to be fairly comfortable. So in the large cap liquid space, for bottom up stock pickers, there are still opportunities in select pockets at reasonable valuations.
Okay, there are pockets of opportunities, but I want to specifically pick, George, 2 or 3 sectors which have suddenly come into a lot of interest: sugar, textile, even a lot of these smaller real estate names are seeing quite a bit of action. Is this something that you are looking at, or just staying away from all of these?
See, we do not have a direct allocation to any of these sectors. But among the sectors you mentioned, real estate, it seems to be in a fairly good cycle, at least for the in the medium term, primarily because, a lot of those players in the markets, there has been decent consolidation in the market. And the current supply is from healthy developers. And a lot of the inventory which was there in the system, that has corrected to a significant extent, and it's at a fairly healthy level now. So even the price increases can be moderate, and it would continue. It can continue at a moderate pace for some time, and that would ensure the affordability does not goes out of whack. And that would ensure, these players should have a reasonably good time going forward. But having said that, the valuations are also factoring a fairly bullish picture for the next few years. So it's quite challenging to find opportunities at reasonable valuations.
That's the biggest problem that a fund manager like yourself has, finding those good businesses at reasonable valuations, because it's getting very, very picky and choosy in the market. But let's talk about the bigger sectors now. IT, what's the view there? Because the jury is out whether one should look at the deal wins or whether one should look at the commentary and the revenue figures that we have been getting.
Yeah, so at some point, we were quite optimistic that, the deal wins should pick up, because IT, because of its essential nature, it cannot, the clients cannot continue with subdued spends for a prolonged period of time, because that's critical for their business functions and things. So, but the recent deal wins, it suggests, there are at least early signs of green shoots in terms of those demand momentum coming back. But in terms of a broad-based demand recovery, our sense is it could be a few quarters away. But given the valuations where they are, at least compared to the broader markets, the current valuations look fairly decent. Having one more thing which we have to factor is, the current valuations are factoring a moderate demand environment in the next 2-3 years. At some point in the next year, our sense is, we could see a meaningful improvement in demand. And at that point, the valuations would look quite attractive based on the current prices.
Fair enough. Need to look at the long-term picture here and not just the imminent one. But George, what's the view on pharma as well? If you're talking about valuation, that's one space which is giving you a bit of a comfort. Is that something that you're looking at incrementally adding?
Yeah, we have a fairly decent position in pharma, slightly more than the benchmark weight. So pharma, if you look at it, the stocks have run up recently, but the outlook remains quite favorable. If you look at the patent cliff, the number of drugs which are coming for patent expiry in the next 2-3 years is quite high compared to what we saw in the last 4-5 years. So that would ensure, players with a reasonable exposure to the US generics market, they would kind of have a reasonable earnings growth, and even the Indian market is doing fairly okay. So from an earnings growth perspective, the sector is quite decent. It's well placed. The only investors have to be concerned about the valuation. The valuations appear fair, but given the recent rally, the upside potential has reduced in many of these stocks.
Fair enough, point taken. And just before I let you go, George, your word as to where you are incrementally adding positions on to. Is that financials? Is there any other sector which you are getting incrementally positive on?
Yeah, so we are bottom-up stock pickers. So our recent additions has been in one of the private sector bank and cement space. The private sector bank where we added has been quite conservative in terms of lending in the last few years, and recently, given the benign NPA cycle and the economic cycle continues to be fairly favorable, so they are hopeful that, and even we are kind of resonating their view that the credit cost could be moderate in the at least in the medium term, and therefore they have increased the pace of lending, and therefore that makes us quite positive on that private sector bank. The other addition which we had was in the cement space, where the player had reasonable levers in terms of improving their cost metrics. And given the push on infra, and there are early signs of private capex revival, our sense is, the volume growth should not be a problem in the medium term.
Okay, George, on that note,